All right, guys, let's go ahead and get started. If you don't mind, double check and make sure you're muted. I got a little bit of background noise starting here, and we will get this show on the road.
Alain, you are confirmed.
And there we go. There's one. Thank you for acknowledging yourself that I can mute. Um, all right, guys. I'm going to start with a question today, and the question is, and it's going to be kind of a two-parter. So, what is the biggest news in the world right now? Okay. What's the biggest news? What's the biggest kind of front page headline news that's maybe shaping the markets? Um, Amy, that's a great answer, by the way. She said Tiger Woods. Um, hey, I'm just going to make a statement. If I was ever a billionaire, okay, you guys can all hold me accountable to this. Force me to hire a full-time driver because I could probably afford it. Okay. So if I'm a billionaire one day, if I win the lottery, if you guys see that I hit the mega millions or something, just take my keys away, like I'm grandpa and make me hire a driver.
Consider me your driver, Mr.
There you go.
Smallhead.
There you
Happy to
go.
help.
So oddly enough, some of you guys might be in our office in South Florida. Um, so the Tiger Woods DUI years ago was literally in front of our office in Jupiter, and Corey Johnson, who's probably on, who runs the office down there, his wife's a realtor, and she was literally showing property on Friday where Tiger somehow flipped his car in a 35 mile per hour speed limit zone. So anyway, thanks for the laugh, Amy. But everybody else says the same thing more or less, right? Which is oil. Okay, oil and Iran. What's happening overseas? What's happening with oil? Certainly has led interest rates to increase. That's put a squeeze on affordability. That's pulled some potential buyers out of the market. So I'm going to ask the second part of that question, which is what is the in the last 30 days, what news is going to have the biggest long-term impact? Okay, so if the biggest headline today is Iran and oil, what news in the last 30 days is going to have the biggest long-term economic impact? Is it Iran or is it something else? Get curious to see if anybody has an opinion of this. So we'll give it a second here. Okay, so Jimmy's got GDP. All right, so we'll wait for a few others. And if you guys want a hint, there's a link at the very top before Aaron sent the summary to an article. And so I'll give you guys my opinion. The biggest news, bigger than long term, bigger than the Iran war, bigger than oil, bigger than anything, is Meta is laying off 20% of their staff. Okay. And why is that the biggest news? Because that signals a complete shift in the way our economy works. And if you look at the article that I shared, um, Meta's not laying off 25 or 20% of their staff because they're losing money. They're not laying off 20% of their staff um, because they need to cut human costs. They're laying off 20% of their staff because they need to reallocate those dollars to building AI infrastructure. And I don't know how many employees Meta has. I think it's, probably north of 25,000, maybe more. So that's a significant number of jobs that are going away. And they're not low paying jobs, low skilled labor. They are highly skilled, white collar, high paid people, probably with very either good degrees or incredible technical expertise, software engineers and coding and things like that. Um, and so if any of us thinks that our jobs are safe as AI kind of becomes implemented and the economy changed, we got our head in the sand. I had a conversation with some of my friends the other day, and one of my friends that's in a business coaching group with me in Northern California is really going down the AI rabbit hole and really building some cool systems. There's two ways that any of us can deal with AI. Um, we can let ourselves be impacted, or we can use it to make ourselves more efficient. And businesses like Meta are saying we can use AI to become more efficient, right? They can produce more output with fewer people. It's not saving them money yet because they have to build and develop the infrastructure. But once they build and develop the infrastructure, think of the cost savings measures that Meta will see with a 20% reduction in their workforce. That's massive. And so I bring this all up today for two reasons. One is um, every one of us needs to spend time and invest time in understanding how to use some of these technologies that are available. I was talking to my mom the other day about it, and she's all, kind of up in arms, like, oh, it's terrible. It's this, that, and the other. And I was like, Mom, what did you say when cell phones came out? You know, like maybe something like, oh, we don't need to be able to talk to people in our car, and landline's enough, right? And what happened over a 10 or 20 period of time, right? Landlines disappeared. Everybody owns a smartphone, and your phone is your computer amongst many other things. And so the economy shifts, and we're going to go through a shift like that. And I mentioned this a few months ago that I think that AI will probably improve like GDP, like economic growth, while at the same time increasing unemployment. And so I mentioned kind of AI for two reasons, like I said. One is we all should spend time understanding how to use, like, don't use the word AI, use technology. Okay. So if you don't think AI is good, if you're worried about like the bots taking over the world, like in Terminator, in some time, switch AI with technology and say, I need to spend more time getting better using the technology that's available to me. But the second piece of this and how it impacts real estate is if people are worried about their jobs, are they going to buy a house? Probably not, right? And so the first two charts I want to share today um, kind of really like spell it out. So I'm gonna share my screen, and as always, all of this information, these charts, graphs, website links, just get with us. Whoever you work with on our team, we will get this in your hands. So the first thing here is job sentiment. Okay, and so this started going down in 2022, kind of at the time that kind of that the post-COVID recovery was ending, inflation spiked, and the economy, was weaker. And you can see, so this blue line here is the percentage of people that think it's a good time, like to be job hunting. That's gone from 70% to 28%, in the last 4 years. And then the percentage of people, kind of the orange dashes, that think it's a bad time has gone from 30 to 72. And so overall sentiment of like your economic reality is how safe are you in your job? Do you think you're going to have a job? Um, are you going to get a raise? I'm not sure if Daniel's on today, but Daniel Betancourt is an Orlando realtor that I work with. And so we had a guy, it was Daniel's listing, under contract, going to double side it, super qualified buyer, easy to work with, slam dunk home run deal, right? And we make an offer, writes contract on a Saturday, and Monday morning he walks into the office and hears that his company's going through layoffs. He wasn't laid off. One of his bosses was, and he's very concerned about, what's his situation. And neither Daniel and I really disagreed with the guy. Like, he canceled because, should you be buying a house when you're worried about getting laid off? Probably not, right? And so when we think about like sentiment of people in the real estate market, if they're not confident in their jobs, either holding their job or future income increases, they're not going to be as apt to make a major financial purchase like a house, right? Um, they're probably not going to stop drinking Starbucks, but they may not be in the real estate market. And so if you guys have been with us for a while, and most of you have, about 6 months ago, we started talking about that we have to identify where our buyers are kind of on the economic totem pole. And we talked a lot about younger people who don't have as long of an established employment history, or people who are a little bit lower income, like on the kind of the overall, rankings percentile. Um, those people are not really in the market to purchase a home and are most affected by rising cost, inflation, higher home prices, things like that. And we talked a lot about 6 months ago about identifying your customers' ability to be a serious buyer. And if someone is younger, newer employed, less stable employment, probably a little bit less cash in the bank, less of a rainy day fund, they're just going to be a little more wishy-washy, a little bit more uncertain about pulling the trigger, being becoming a first-time home buyer or a move-up buyer, selling and buying something new or buying a vacation home. They're just going to have less confidence. And we talked a lot about identifying where your buyers fall on that, because a little bit older, a little bit more established, a little bit higher income, a little more stable, those people were taking more action looking at real estate in the last 6 months. And that's a reason why the average age of a first-time home buyer has almost gone up to 40 years old from, used to be in the like 32, 33-year-old range 7 or 8 years ago. It's just younger people are not as confident about their jobs. Now, what we're starting to see is that starting to creep up a little bit. And so this chart is an overall chart of kind of the overall market. The second thing I'm going to share here is just overall consumer sentiment. This is just kind of a poll. The University of Michigan does it, kind of a positive, negative view of the economy. Consumer sentiment is very low. It got down in this range here in 2022 when inflation spiked, and then it improved a little bit. But in the last 6 months, it's deteriorated a little bit. And we're at levels that we saw like in 2010, like financial crisis, back in the early 80s when inflation, skyrocketed and interest rates were 15%. So the overall sentiment of the American consumer is poor and has been for the last couple of years, really starting in 2022, but it's not really getting better. Both, overall, opinion of the economy, consumer sentiment, and then, job prospects. And so it feels like you're starting to see some of that sentiment creep into a little bit higher income brackets, a little bit older people that are more established, people that 6 months ago or a year ago may have still felt comfortable making a purchase that seem to be maybe slowing down a little bit due to uncertainty. I found this just here's a chart of the S&P 500. And so if we look over the past 12 months, the S&P is up, right? But if we look over the last month, since the conflict in Iran started, what's the stock market done? It's down. We were at 6,400, or 60, not about 6,900 here, and we're down to around 6,400. Not a bear market, not a major sell-off, but if you've got some assets, are you as apt to make large purchases right now? Right? Probably not. This chart here is oil prices. Again, over the past month, $70 to $100, right, a barrel. That's why we're seeing gas prices go higher. That's why there's fears of inflation going up. That's why mortgage rates have gone up. And so the overall sentiment of the economy has been drifting kind of in a negative or weaker manner for really about 4 years now, since 2022. The conflict in Iran has certainly increased that a little bit. And I think when it started, I think a lot of people expected it to be over quickly. Think of like the quick strike into Venezuela to take out Maduro, right? That was like overnight, quick and done. The longer this drags on, it'll not only have an impact on oil prices, but it'll also have an impact on consumer sentiment. And so that's the thing we have to start watching is, does the consumer start to lose confidence in whatever it's their job, the overall economy, the prospects of buying real estate? So something we got to watch. That consumer sentiment number, I think, is really important. And when people tend to be, kind of follow a herd mentality. Like I would argue, and probably many of you, that now actually might be a great time to buy. If the market is, not as robust as a typical like spring market would be nationwide, if higher rates have pulled some people back, that tells me there's opportunities for the buyers that are still in the market. And I think that's what we have to explain to people. But generally speaking, people follow a herd mentality. And if their friend's not doing something, they're not going to do it either. And so if people hear, oh, it's about time to buy, interest rates are up, what are most people going to do? Most people are going to pull back a little bit because they tend to follow kind of that herd mentality. So I think it's important for us to really educate people on the opportunities afforded to them in a market like we're seeing today, where things are a little bit slower than you might see in a typical robust spring. And certainly the last 30 days, you've noticed a little bit of that. But for us, we have to identify who has the ability to buy confidently today that just needs education, and who actually truly has something to worry about. Like the client that Daniel and I had, that we use that example. Like that person's not going to buy, and they probably shouldn't, right? If their company's going through layoffs, it might be appropriate to pump the brakes for 30, 60, or 90 days and let the dust settle. But if your company's not going through that, there's opportunities in today's market. And so I think the education piece with people of what's actually happening is important. but also us understanding all of our clients have different situations. And if someone is strong, stable, older, established, has some cash in the bank, now's a great time. And so we just have to, I think, do a really good job of asking questions up front and identifying who they are and where they are. Um, Lots of us on our team have people we pre-approved 3 months ago, 6 months ago, 12 months ago, 2 years ago that haven't purchased yet. Um, when we did our initial consult, I think everybody in this call probably does an initial consult where we ask some questions, needs, wants, goals, budgets, things like that. It's probably appropriate if someone hasn't purchased and they've been a lead, for the last 3, 6 months or longer. It's probably appropriate to redo that initial consult, kind of take their pulse. Like, hey, I know when we started talking 6 months ago, your budget was this. Here's what you thought. You were comfortable with this. Your job was good. Has anything changed? I think that's an appropriate conversation. It's a great lead in for us to figure out where they're at. And then also gives us an opportunity to educate them proactively on what we're seeing in the market and identify like if they are comfortable with their employment situation um, and like their personal economic standing, then we can educate them on, okay, well, then if you're comfortable, your job's good, here's where we see the opportunities. Because a weaker market like we're in now, which, this may persist for a little bit longer, certainly, brings opportunities as well. All right, I'm going to jump in here. I'm going to share the bond market chart just so you guys can kind of see what's happening. So, this is the last 30 days. We've had a pretty big bond market sell-off as we've been talking about the past couple weeks. So the last few Mondays, we've seen rallies. And so this is kind of a trend that has started to take shape. So Monday the 16th, Tuesday the 17th, we had some rallies. Wednesday, Thursday, Friday, we sold off. Last week, Monday, we had a little rally. Weak on Tuesday, but better on Wednesday. Thursday, sell off. Friday, we bottomed. And then we're starting this week, we're up 32 basis points. So, that's like approaching an eighth of a percent in interest rate that we've improved just this morning. And it seems like the trend is weekend news might improve things on Monday, but then if those things don't follow through, the market deteriorates a little bit as the week goes. This weekend was a little bit odd because the last 3 or 4 weeks, the president, Scott Bessent, his Treasury Secretary, those two in particular, were really in the media, either doing interviews or tweeting. And we talked about this last couple of weeks. The administration is using the weekend to kind of float ideas and gauge market reaction, trying to give the market a positive opening on Monday. And so the last 2 weekends, you've heard things like potential ceasefire, things winding down. We're doing things to open the Strait of Hormuz that would bring oil prices down. That caused the market to improve a little bit on Monday or Tuesday. But then you might hear some conflicting things from Iran middle of the week and the market deteriorates. And that's kind of been a path we've seen the last 2 or 3 weeks. They were a little bit quiet this weekend, and I think the market is trying to gauge what does that mean? Does that mean that we're looking at a ground invasion and a longer, more protracted war? There's certainly troops being shipped overseas right now, but is that negotiations? Is that trying to negotiate from a position of strength, or is that a reality? The market's trying to anticipate that. So even though today's a good sign and the market's improved a little bit, we've got some support levels that are kind of beneath us, hoping to kind of stop the bleeding a little bit. Things can change in a moment's notice. So it'll be interesting to watch what happens this week, but same story as the last few weeks. We just want to see, like, is there progress being made, toward an ultimate, peaceful resolution that would open the Strait of Hormuz back up, that would bring oil prices back down and, would improve inflation, improve interest rates. So it's kind of what the market's looking for. The market's just trying to identify, what's the likelihood of that happening. Okay, I'm going to jump into something that has been announced the last few weeks, and a lot of lenders have talked about it here. And I just wanted to briefly mention it before we wrap up the call today. So you've seen a lot of lenders talk about or posting that condo guidelines are changing. And just wanted to give you kind of a high level of what to expect, because there are some changes to how condos get approved. a few things are positive, a few things can make it more challenging. So on the positive end of things, the occupancy ratio is going away. So in the past, if someone was purchasing a condo, depending upon what their intentions were, you had to identify what percentage of the existing owners were owner occupants or investors. That's going away. In Florida, where we are, it's going to be easier to finance new condo developments. What's called a PERS approval is no longer required. That's a positive development. Um, the biggest change that could be construed as a negative is condo reserves are going up from 10 to 15%. Seems like that's probably an appropriate response because so many condos have seen special assessments where they've had to dip into their reserves to or hit people with special assessments where they didn't have enough reserves, to put new roofs on or like fortify, like engineering report, says you got to replace stairwells or things like that. So it feels like that's probably appropriate, but that's going to change things. And so you could see a little bit of difficulty with condo financing as that goes up. That's pushed back to January of next year, so there's time, but that's a change that's coming. Um, but anything you guys saw on condos is not really a direct impact today. It's all kind of a phase rolled in approach. So if you guys have seen lenders talking about condo changes, nothing really specific that has to happen like right now. Some of the changes are kind of phased in over the next few months, and then in some cases not till next January. And we'll do some classes and talk more in details on this call at a later date with that. Um, Another big change that I wanted to talk about was insurance. So Fannie Mae and Freddie Mac are allowing you to insure your roof replacement cost for what's called actual cash value, not replacement cost. And so here's basically what that means. So typically a homeowner's insurance policy insures the house and other items like the roof for full replacement cost. So if I get hit by a hailstorm and I need a new roof and I file a claim, whatever the cost of the roof is, that's what my insurance company will pay out. No different than like if my house burned down, they're going to cover the replacement cost. How do I replace and rebuild the house? How do I replace this roof if I have a total loss of a roof? Um, a couple years ago, some condominiums started insuring roofs not for the replacement cost of the roof, but for the actual cash value. And so what that means is, let's say you have a condo and the collective roofs are worth $200,000. Okay. So replacement cost would be $200,000 if you need to replace all the roofs. And if the roofs were damaged and you had to file a claim, $200,000 is what an HOA would receive to replace the roofs. A lot of condos started insuring roofs for the actual cash value, which is basically the depreciated value. So a $200,000 roof that, let's say it's 5 years old, might only be worth $125,000 today. Actual cash value insurance would only then pay out $125,000. So it will like cover the depreciated value of the roof. And so you saw some condo challenges over the last few years because lenders didn't like that. Lenders wanted the replacement cost to be covered. That's also now going to be allowed for single family homes. Okay, so let's say I have a single family home and I have a $20,000 roof. In the past, if I filed a claim and I had replacement cost, they would write me a check for 20 grand to replace my full roof. Fannie Mae and Freddie Mac are now going to allow for actual cash value roof replacement on single family homes. So if I have a $20,000 roof that I've had for a number of years and it's now only worth $10,000 and I had a total loss, hailstorm, hurricane, something like that, and I filed a claim, the insurance company would only pay me $10,000 because that's the actual cash or depreciated value. In fact, they wouldn't pay you 10 grand because they pay you 10 grand minus your deductible. So, so if let's try to figure out who's got the unmute on here. Okay, I think we got him off. So actual cash value, could that provide a lower premium? Absolutely, right? And so if our clients are asking us questions about what's appropriate, I think like anything, the advice we should give them is, you get what you pay for. Like people can take insurance policies with lower like valuables or liability coverage that would be a cheaper premium, but could expose you to more risk in the future. And so, as the ability for people to do actual cash value on traditional single family homes for their roof, as that becomes a little more commonplace and people understand it, it's definitely a way that people can achieve a lower premium. But again, there's some risk with that because they're also going to be less covered. So it's an interesting option for us to have. And I could see people who buy houses with older roofs that know it will need to be replaced and they probably don't anticipate filing a claim to replace it. I could see some people using that to get cheaper premiums if they're anticipating replacing their roof anyway in the future, and then maybe they switch it back to a replacement cost. Um, if someone has a brand new roof, I think you're probably going to see people do replacement costs. But it'll be interesting to see kind of how that plays out. But just wanted to take a moment to kind of walk you through what that looks like. Um, with that, guys, it's right at 10:30, so we'll let you run. Have a great day. Have a great week. Big news of the week, guys, is obviously Iran and oil. That'll move the markets. And then this Friday, we do get a big jobs report. So that'll be a market mover as well. So we will talk about that with you guys next Monday. Thanks, everybody. Have a great week.